Hi, my name's Tim and I'm an economist at the Reserve Bank of Australia. In this video, I'll provide a brief summary of current economic conditions as published in our February Statement on Monetary Policy. This quarter, we've also got a special focus on what's driving inflation in the Australian economy. But let's start by looking at the global backdrop. In most advanced economies, year-ended inflation remains high and well above central banks' inflation targets. When we're looking at prices, we can look at headline inflation, the overall measure, or core inflation, which excludes more volatile energy and food prices. This is also known as underlying inflation. Both measures have moderated over recent months, suggesting that inflation may have peaked in late 2022. This graph shows what's driving headline inflation for the US and Euro area. You can see that much of the recent moderation in inflation has occurred because energy prices, in red, have declined over recent months. This reflects lower demand and the gradual resolution of supply disruptions related to oil and gas. In contrast, core services inflation, in light orange, is now the main driver of overall inflation in advanced economies. Housing services inflation, or more simply rental prices, has been a key contributor to this. Turning to economic activity now, global growth moderated over 2022 and is forecast to remain well below its historical average over the next 2 years, as it is constrained by higher interest rates in most economies. That being said, the near-term outlook has improved a little after China dropped most of its COVID-19 restrictions earlier than expected, inflation showed clearer signs of peaking, and global gas prices declined. Central banks in most economies have increased their policy rates further to address high inflation. They are trying to avoid the risk that expectations of higher prices become embedded in consumer and business behaviour. In this graph, we can see how policy rates have evolved over time since 2019, as well as market participants' expectations for the future path of policy rates, shown by the dotted lines. Most advanced economy central banks have slowed the pace of policy rate increases recently. However, several have signalled that their policy rates will need to be raised further and remain at restrictive levels for some time to return inflation to target. You can see from the dotted lines that further increases in policy rates are expected by the market. And we can see that policy rates are generally expected to peak in the first half of 2023 before declining a little in the second half of the year. Turning now to the domestic economy, economic activity grew at a solid pace over the second half of 2022, but has moderated since the first half of last year, as the initial bounce back from pandemic-related restrictions seems to have mostly run its course. The Australian economy grew by 0.6% in the September quarter. And to see what drove this result, we can look at the contribution from the different categories of expenditure in the economy. Growth in household consumption, which is shown in yellow, was solid in the quarter, underpinned by an increase in spending on discretionary services. GDP growth was also boosted by continued strength in exports, in purple, reflecting strong growth in services and rural exports. Imports, in red, subtracted from growth in the quarter amid the strong demand for overseas travel by Australians and as order backlogs were filled. Looking forward, GDP growth is expected to have been 2.75% over 2022 and is forecast to be 1.5% over both 2023 and 2024. The forecast slowdown in growth reflects the effects of higher interest rates, the higher cost of living, and declining household wealth. However, the impact of these factors on household consumption, against the backdrop of strong labour market outcomes, creates some uncertainty around the domestic growth outlook. Solid growth in the domestic economy last year has supported large increases in employment. And as you can see from the blue line in the graph, the unemployment rate remained around 3.5% in late 2022, its lowest level in nearly 50 years. The demand for workers is strong, though it has moderated a little in recent months. Some of this demand has been met by a strong recovery in net arrivals from overseas, as well as greater workforce participation by young people and females, all of which is helping to alleviate labour shortages in some areas. Even so, the labour market remains tight. The unemployment rate is expected to remain around 3.5% until mid-2023, before rising as economic growth slows. Wages growth was strong in the September quarter and is expected to pick up further in the period ahead. The Wage Price Index, or WPI, grew by 3.1% over the year to September. This was the highest rate of year-ended wages growth since 2013 and reflected tightness in the labour market, high inflation outcomes, and the pass-through of the wage policy decision in June by the Fair Work Commission. That's an independent Australian body responsible for setting national minimum wages and employment conditions. Growth in the WPI is expected to reach 4.25% in late 2023, before declining to 3.75% in mid-2025. Inflation in Australia remains high and broadly based, but is likely to have peaked at the end of 2022. Global factors explain much of this high inflation, but strong domestic demand, a tight labour market, flood-related disruptions, and capacity constraints have also played a role. Keep watching as we unpack these drivers further at the end of this video in our special focus slide. The headline Consumer Price Index, or CPI, increased by 1.9% in the December quarter and by 7.8% over the year. This is the highest year-ended CPI inflation since 1990. And as can be seen in this graph, a wide range of items have contributed to the strong inflation outcomes over the past year. Alongside the headline inflation outcomes, measures of underlying inflation were also high in the December quarter. And recall that these measures remove the effect of irregular or temporary price changes. One measure of this is trimmed mean inflation. And in this graph, we can see that trimmed mean inflation was 1.7% in the quarter and 6.9% over the year, the highest annual rate since 1988. Looking forward, inflation is expected to decline over the coming years to be around the top of the 2 to 3% target by mid-2025. Let's turn to the operation of monetary policy now. The bank's board has stated that its priority is to return inflation to the 2 to 3% target range over time. High inflation makes life difficult for people and damages the functioning of the economy. And if high inflation were to become entrenched in people's expectations, it would be very costly to reduce later. To achieve this goal, and as we can see in this graph here, the board has increased the cash rate materially since May 2022. The board expects that further increases in interest rates will be needed over the months ahead to ensure that inflation returns to target, and that this period of high inflation is only temporary. In determining future interest rate movements, the board will be paying close attention to developments in the global economy, trends in household consumption, and the outlook for inflation and the labour market. So this is where we'd normally wrap things up for our regular updates. But for this round, we have included a bonus chart on what has been driving the increases in inflation recently. We know inflation has increased significantly over the past year or so. But is this coming from the demand side, where perhaps an increase in spending has pushed up aggregate demand and caused demand pull inflation? Or is it coming from the supply side, where a reduction in aggregate supply related to higher production costs or other disruptions has caused cost push inflation? These are important questions for economists and policymakers. So taking a look at some of the estimates done by RBA economists, this graph suggests that, according to the particular type of economic model used here, that supply side factors in blue have accounted for around half of the increase in inflation in Australia over the past year. These supply issues have been related to the war in Ukraine, other global supply disruptions resulting from the COVID-19 pandemic, and domestic supply disruptions from poor weather. But demand-side factors in red have also played a role. Strong domestic and global demand has been supported by the significant fiscal and monetary policy responses to the pandemic and the rapid economic recovery following the faster than expected development of effective vaccines. So thanks for watching this update. You can find the full February statement as well as a link to our explainer on the causes of inflation below.